Florida sells a dream better than almost anywhere in America. Blue water, bright mornings, new towers rising over the skyline, new suburbs stretching into the horizon, a place where people imagine their stress dissolving the moment they cross the state line. But in 2026, Florida home buying has a risk layer that many buyers do not fully price in until it is too late. Because in Florida, the cost of the home is only the first page of the story. The real story starts after closing. Insurance premiums that can jump without warning after a storm season, deductibles that turn a claim into a financial gut punch, property taxes that reset when a home changes hands, HOA dues that climb every year and sometimes spike overnight, condo reserve requirements and special assessments that can add hundreds or even thousands per month in places that look like luxury on the surface. And then there's the market itself, shifting into a slower rhythm where sellers have to compete harder and homes sit longer in many parts of the state. Florida is not one housing market, it is dozens of markets stacked on top of each other. Some areas are still strong, some areas are stabilizing, some areas are turning into a negotiation arena where buyers have leverage again. Redfin data showed Florida homes taking longer to sell late last year, with median days on market around 80 days in December 2025. Zillow also showed a large share of sales closing under list price, a sign that the market has shifted away from the frenzy era. That does not mean Florida is collapsing. It means the easy assumptions are gone. So today, we're counting down the top 10 worst cities to buy a home in Florida in 2026. Not because these places are horrible. Some are stunning. Some are full of jobs and energy. Some are places you might love. But the housing risk is about timing, total cost, and the ability to exit later without taking a hit. And in these 10 cities, the math can get dangerous fast. Now, let's start the countdown.
Number 10. Cape Coral. Cape Coral is one of those places that can feel like a shortcut to the Florida lifestyle. Waterfront canals, boat culture, sunshine that makes every day look like a postcard. And compared to some of the coastal glamour markets, it can look like a deal. But in 2026, Cape Coral carries a specific kind of danger that buyers underestimate. It is a market where supply can move faster than demand. Southwest Florida has seen years of building, listing growth, and investor activity, and when you combine that with a buyer pool that is extremely payment sensitive, the market can turn from hot to heavy in a hurry. When rates are elevated and insurance costs stay high, many buyers do not stretch, they step back. And Cape Coral is not just exposed to market cycles, it is exposed to a cost shock cycle. If you are anywhere near water in Florida, you are never just buying a home. You are buying a cost structure that can change based on storms, reinsurance pricing, and carrier decisions. Even when a property is not directly on the coast, the region is priced as a region. One bad season can change the way insurers view an entire area, not just one street. Florida has shown signs of insurance relief and rate decrease filings for 2026 from some carriers, but the bigger truth is that costs remain a major variable and the buyer experience is still shaped by uncertainty. Here's the trap in Cape Coral. A buyer sees the list price and thinks they found value. Then the insurance quote lands. Then the flood component, the wind component, the deductibles, the inspection requirements, and suddenly the monthly payment is not what they imagined. If they still buy, they're locking in a high carrying cost in a market where resale can slow quickly if buyer sentiment cools. Cape Coral can absolutely work for the right buyer who is conservative, well-funded, and thinking long-term. But if you are buying in 2026 expecting quick appreciation and easy exit liquidity, Cape Coral is one of those places where the door can feel wide open on the way in and narrow on the way out.
Number 9. Jacksonville. Jacksonville has a reputation that makes buyers feel safe. It is big, it has jobs, it has neighborhoods that still look relatively affordable compared to South Florida, and it has been a major destination for people relocating from higher-cost states. But 2026 is about the change in rhythm. When a city becomes a relocation magnet for a long time, Prices rise in a way that assumes the flow continues forever. Then the market hits a phase where buyers become cautious, and the same city that felt like a bargain starts feeling like a tough value proposition, especially when taxes, insurance, and commuting costs are layered in. Jacksonville is also a city where insurance pain is not limited to beachfront property. Wind, storms, and regional risk pricing can hit homes far from the sand. For many households, the monthly payment is not just a mortgage. It is a mortgage plus an insurance bill that can feel like a second mortgage. Now, add the market mechanics. When homes sit longer, sellers compete. When sellers compete, buyers start demanding concessions, and the danger for a buyer is purchasing at a price that was set in an older psychology, when the market is now operating under a new psychology. Redfin showed Florida's market cooling in terms of time to sell late last year. That matters because Jacksonville depends heavily on financed buyers, not pure cash. Financed buyers are the first to hesitate when the total monthly payment starts to look heavy. If you buy in Jacksonville at a premium price, expecting the relocation wave to instantly bail you out later, you are taking a risk that demand will remain stronger than supply and that costs will not climb. In Florida, those are two assumptions you should never treat as guaranteed. If you're enjoying this breakdown, subscribe to Discover the Nation because the next cities show how Florida risk is not just about storms, it's about the total cost machine that turns good cities into risky purchases.
Number 8. Orlando. Orlando is a powerhouse, and that is exactly why it can be dangerous. It is one of the most recognized brands in American tourism and entertainment. It has constant development, new communities, new jobs, new arrivals, and a steady supply of investors who see rental opportunity. But in 2026, Orlando carries 3 pressure points that buyers cannot ignore. First is investor sensitivity. Investor-heavy markets can change mood quickly. When rents stop rising fast, when vacancy increases, when short-term rental rules tighten in certain areas, or when operating costs jump, the investor inventory can come back to market at the worst time. And when multiple investor owners decide to exit around the same time, it adds supply exactly when the market least needs it. Second is new construction competition. Orlando has an enormous supply machine. Builders can offer incentives that regular resale sellers cannot match. Rate buydowns, closing cost credits, upgrades, and promotions that are effectively hidden price cuts. A buyer might pay a similar sticker price, but the builder deal is cheaper in reality. That forces resale sellers to chase the builder market down. That is how softening becomes a trend without looking like a crash. Third is the ownership burden. Insurance, taxes, HOA dues in many master-planned communities, utility costs that rise with heat, maintenance that comes with humidity. Orlando may not be a beachfront market, but Florida costs do not stop at the coast. The market is also no longer the frenzied machine it was. Zillow data showed a large share of Florida homes selling under list price in late 2025. That is a sign that buyers are negotiating harder, and that matters in a city with a lot of inventory options. Orlando is still a strong city, but buying in Orlando in 2026 can be risky if you overpay for a home that will be competing against builder inventory and investor listings later, while you carry a monthly cost that only goes one direction over time.
Number 7. Tampa. Tampa is one of the clearest examples of Florida's modern transformation. For years, it has been marketed as the balanced Florida city. Water nearby, downtown energy, job growth, sports culture, a place that feels like it has momentum without the extreme price tag of Miami. But in 2026, Tampa is a market where buyers need to be brutally honest about what they're paying for, because a lot of Tampa's pricing was built on the assumption that demand will always outrun supply. Now the market is more negotiated, more patient, more selective. And Tampa also lives inside Florida's insurance reality. You do not need to be directly on the sand for the insurance market to affect your monthly payment. Florida's broader risk environment shapes premiums and deductibles in ways that surprise buyers, especially newcomers who are used to more stable insurance pricing.
Florida realtors and other observers have discussed market stabilization moving into 2026, but stabilization does not mean cheap. It means the market is finding a new balance after volatility, and balance often comes through slower sales and more negotiation, not through instant appreciation. Here's the Tampa trap. A buyer falls in love with the story and pays the premium. Then they realize the premium also comes with recurring costs, and in a slower market, premium pricing is punished first. When buyers get cautious, they don't stop buying everything, they stop overpaying, they stop stretching, they start looking for concessions. If Tampa enters a phase where buyers can wait and choose, then the seller who needs to exit quickly is forced to discount. That's why liquidity matters more than pride in 2026. If you're buying in Tampa this year, the safest approach is not emotional, it's mathematical. You buy only when the total monthly burden makes sense and when the price gives you a cushion against a market that may not reward you for several years.
Number 6. Fort Lauderdale. Fort Lauderdale looks like the upgraded Florida lifestyle. Coastal energy, walkable pockets, luxury condos, boat culture. A city that feels like it is constantly reinventing itself. But in 2026, Fort Lauderdale is one of the most dangerous places to buy if you do not fully understand the condo cost structure and the negotiation trend. Redfin reported that buyers were getting large discounts in 2025 in places including Fort Lauderdale, with meaningful shares of homes selling below asking. That is a signal that leverage has shifted. Now, add the condo layer. Florida condo markets are dealing with a new era of transparency, reserve funding, and structural integrity reserve study requirements, with major deadlines around the end of 2025 and additional disclosure rules taking effect in early 2026. This is where buyers get trapped. They tour a building, it feels like a resort, the listing price seems fair compared to Miami. Then the documents arrive. Reserve funding, maintenance projects, inspection outcomes, potential assessments, rising dues. In some buildings, the monthly HOA burden can jump dramatically, and buyers who did not plan for it end up forced to sell, often into a market where other owners are also trying to exit. Even for single-family homes, Fort Lauderdale is not immune to Florida's cost machine. Insurance uncertainty, flood considerations, and a luxury market that can cool quickly when buyers become cautious. If you buy in Fort Lauderdale in 2026, you are not just buying property, you are buying a governance and cost environment. If you do not read the documents and price in the worst-case monthly burden, you can buy yourself into a financial chokehold. Subscribe to Discover the Nation if you want more breakdowns like this, because the next cities are where Florida's premium pricing collides with Florida's premium risk.
Number 5. West Palm Beach. West Palm Beach has been one of the headline Florida markets. It became a symbol of migration, wealth movement, and post-boom demand. The area has attracted high-income newcomers, and the market has felt like it could defy gravity for years. But in 2026, West Palm Beach represents a core risk for buyers. It is a market where the downside is not always a dramatic crash. The downside is paying peak-era prices, while your ability to sell later depends on the next buyer accepting the same premium. Redfin reported big buyer discounts in places including West Palm Beach in 2025, which signals a market where sellers had to give ground. Now layer the Florida cost structure on top. Insurance is still one of the biggest variables in Florida homeownership. Even where some rate decreases may be filed, the overall reality for many buyers is still uncertainty and volatility, and that uncertainty affects demand. In West Palm Beach, a lot of buyers are paying for lifestyle and brand, but lifestyle and brand do not guarantee appreciation when the market slows. And when the market slows, luxury and premium segments often become the most negotiable. The trap is simple. You buy a premium home, you pay premium taxes, you pay premium insurance, then the market stops appreciating fast and your total cost keeps rising anyway.
That is how a dream purchase turns into a slow-motion budget drain. West Palm Beach can be incredible for the right buyer who has cash reserves and is planning to stay. But if you were a financed buyer, stretching to buy a premium home in 2026, you are playing a dangerous game where one cost shock or one market dip can remove your flexibility.
Number 4. Naples. Naples is one of Florida's most glamorous markets. It is luxury, leisure, and prestige packaged into one coastal label. But in 2026, Naples is one of the clearest examples of how beauty can hide risk. Luxury markets depend on confidence. When confidence is high, buyers pay premiums quickly. When confidence is cautious, luxury becomes a negotiation arena. And in Florida, luxury is also wrapped around a cost structure that can be brutal. Insurance is not an abstract concept in Naples. It is a real line item that can reshape affordability and buyer behavior. And Naples also carries risk from storm exposure, even for properties that are not directly on the beach. Now, add the condo dimension again. Across Florida, condos have become a document-driven purchase. Structural reserve studies, reserves, and disclosures are now central to buyer decisions, and buildings that cannot demonstrate strong reserves can see demand evaporate. Naples has many buildings, communities, and associations with substantial maintenance requirements. If you buy into a community with large deferred maintenance or reserve shortfalls, you can be hit with assessments that turn a luxury lifestyle into a financial burden. The biggest Naples trap is overconfidence. Buyers assume that because it is Naples, it will always be easy to sell. But in a cautious cycle, a luxury buyer has options. They can wait, they can negotiate, they can demand perfection. And when they do, the seller who needs to move becomes the one paying the discount. Naples is not a market to buy on emotion. In 2026, it is a market to buy only with discipline, document review, and a monthly cost cushion that can survive surprises.
Number 3. Sarasota. Sarasota is one of Florida's most desired lifestyle markets. Culture, beaches, and that polished coastal identity that makes people feel like they are buying into a better version of life. It is the kind of place where the sunset sells the deal before the buyer even reads the numbers. But Sarasota carries a unique risk profile in 2026 because it was one of the markets where the boom-era psychology ran hot. A lot of buyers paid top dollar because they believed Sarasota would always be protected by demand. They believed the lifestyle would always create urgency. They believed the next buyer would always pay more. Now the market is more balanced, and balance is where overpaying becomes dangerous. In a balanced market, buyers do not rush. They compare, they negotiate, they ask for credits, they choose the best value, not the first listing that looks pretty. And when buyers have leverage, the most overpriced homes become the ones that sit. Sarasota is also heavily exposed to Florida's cost structure. Insurance volatility is real. Storm season anxiety is real. HOA dues in many communities are real. Maintenance costs are real in coastal humidity, salt air, and intense sun that wears everything down faster than newcomers expect. If you buy a home that requires constant upkeep and your costs rise while appreciation slows, your outcome can disappoint, even if you love the location. Sarasota also has a second risk that buyers forget. A large share of demand is tied to discretionary movement. People choosing Florida, people choosing lifestyle, people choosing retirement or second homes. When the economy feels uncertain, discretionary buyers pause. And when discretionary buyers pause, sellers compete harder and price cuts become normal. That is the Sarasota danger. Not that it turns into a ghost town. The danger is a slower market where sellers have to concede, and the buyer who overpaid becomes the one trapped holding the most expensive version of the same asset everyone else is now negotiating down.
Number 2. Miami. Miami is a city that sells intensity. It sells status. It sells the feeling that the world is coming to you. The brand is global, the energy is constant, and the skyline looks like a promise.
And that global magnet effect is exactly why buying a home in Miami in 2026 can be one of the most dangerous decisions a buyer can make if they do not price risk correctly. Miami has premium pricing and premium volatility. It is influenced by international money, luxury sentiment, and sudden shifts in demand. That creates swings between competition and caution that can happen faster than buyers expect. One year it feels unstoppable. The next year it feels negotiable. And in 2026, the mood has shifted toward leverage for buyers in many segments. Now add the Florida cost machine. Insurance is a major factor. Flood considerations matter. Wind considerations matter. And condo cost structures can change dramatically with reserves, repairs, and assessments. Miami has many buildings where the monthly cost is not just an HOA fee, it can become a second payment that rises over time. That is why Miami's trap is psychological. Buyers see the lifestyle and assume the market will protect them. But a market does not protect you if you buy at the wrong price in the wrong cycle. When buyers get cautious, premium markets become the most negotiable markets because the buyer pool is smaller and more selective. And in Miami, negotiations can be brutal because there's always another option, another building, another unit, another seller willing to move. If you are buying in Miami in 2026, understand what your exit requires. It requires future buyers accepting a premium while also accepting a heavy cost structure. If costs rise, the buyer pool shrinks. If the buyer pool shrinks, liquidity drops. And when liquidity drops, discounts become normal, and time on market becomes longer. Miami is still Miami, but buying a home there in 2026 is not a guaranteed win. It is a high-stakes purchase that demands discipline, patience, and a refusal to chase fantasy pricing just because the city feels like it will always be the exception. Number 1. Fort Myers. Fort Myers takes the number 1 spot on this list because it concentrates multiple Florida risks into one purchase. It is a market that has seen huge attention, huge rebuilding narratives, and huge emotional demand, especially in the wake of major storm seasons. That emotional demand is the danger, because emotional demand pushes buyers to overpay and to ignore the long-term cost structure. Fort Myers has storm exposure risk that is not theoretical. That risk shows up in insurance pricing, deductibles, coverage requirements, and buyer hesitation. It also shows up in the way neighborhoods can change in desirability when storms reshape perceptions. Fort Myers also has supply dynamics that can pressure prices. When an area rebuilds and new inventory comes online, supply can rise faster than demand can absorb, especially when the buyer pool is payment sensitive. And in Florida, payment sensitivity is often driven by insurance, not just rates. Even when headlines talk about insurance relief, the lived reality for many buyers is still unpredictability, and unpredictability changes buyer behavior. Here is the Fort Myers trap. A buyer finds a home that looks like it should appreciate because Florida is popular. They buy expecting the past to repeat. Then the cost structure hits them. Insurance renewal, deductibles, maintenance, potential flood requirements, and they realize they are carrying a heavy monthly burden in a market where future buyers may hesitate. In a slower market, the buyer who needs to sell quickly becomes the one paying the discount. And in coastal risk markets, buyers become extremely picky. They want strong mitigation features, they want newer roofs, they want stronger windows, they want better elevation, they want proof the home is insurable at a reasonable price. If you buy in Fort Myers in 2026 without building a large safety cushion into your finances and without demanding a deal that protects you, you could be walking into a slow-motion equity trap where costs rise faster than value. This countdown was not about hating on Florida. Florida is still one of the most desirable states in America. It still has lifestyle, energy, and opportunity. But in 2026, Florida home buying is not about the dream. It is about the total math. The market has shifted into a more negotiated era in many places, with more sales happening under list price and longer selling timelines showing up in statewide indicators late last year. And when you combine that market shift with Florida's cost structure, insurance uncertainty, HOA and condo cost risk, and the reality that storms can reshape ownership expenses overnight, the worst time to buy is when you buy on emotion instead of numbers. If this video helped you see the warning signs clearly, tap like, subscribe to Discover the Nation, and comment the next Florida city you want investigated.